So you wanna go to war with me? You're talking like you think you're royalty. You think that I'm afraid, but I don't break. I heard you question my stability. You think I'll fall just like a guillotine, but I am here to stay. Won't look away. The storm is coming, so you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the. I'm coming for the throne. I'm coming for the throne. So you wanna be my enemy? You should've known I'd never kiss the rain. Ice runs in my veins, won't play it safe. I don't belong with your nobility. Who died and made you king of anything? You think that I'm insane, it's your mistake. Kingdoms rise and fall, I've come to take it all. I'll take it, I've come to take it. Kingdoms rise and fall, I've come to take it all. I'll take it all. The storm is coming, so you better start running. No, you can't control, feel it in my bones. I'm coming for the, coming for the. I'm coming for the throne. I'm coming for the throne.
Let's go. Yo, I'm like an addict, do I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it, fuse like a magnet. Lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. I send the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I was built to last. You move slow and I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same, cause that's what it takes.
Always
on, I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same, 'cause that's what it takes.
All right, y'all. Happy Tuesday, February 24th. Let's get it. We got the AMC earnings call starting in about 5 minutes. They released the results already yesterday early because of the debt restructuring. They had to get the results out, the formal ones. And we're waiting, I don't know, a couple days, maybe a couple weeks for a next 8K about any debt restructuring, what the terms of that look like. We know the amount they're trying to sell, around $2.4 billion to restructure the term loan and the 2027 Odeon bonds. They say they're trying to get a better interest rate. We'll cross fingers on that. I'm not going to talk about that until we see it. And let's go over this press release here in 2 minutes. And then we'll find out what management has to say and see if there are any analyst or investor questions. For the fourth quarter, revenues were slightly down. You can see, maybe I can make this a little bit bigger for you. Revenues were 1.28 billion versus 1.3 billion a year ago. Net loss was not as bad by $8 million, $127 million for the fourth quarter loss versus 135 a year ago. Adjusted EBITDA down a little bit, 134 million compared to 164. Net cash provided by operating activities, positive 126 million. Free cash flow, positive 43 million. We were expecting that because of Q4, the way accounts payable and accounts receivable revenues flow in Q4 on a high box office quarter. And so cash goes up. It looks like a good quarter, but those bills will be due in Q1. And sorry to be the guy to keep reminding you guys about that, but cash flow always looks good in Q4. The piper's gonna be paid in Q1. And there'll be a lot of people out there trying to get you to not focus on that or say I'm being too negative by talking about how bad Q1 cash burn is going to be. I think you should be informed and not have your head in the sand. That's not being negative. The numbers are the numbers. I don't make up the numbers. If they were good, we'd call them good, but you need to know what to expect if you're trying to speculate in the stock. I still have no position because of the ongoing dilution and reverse split risk. Let's just see what happens in the next 30 days. Cash and cash equivalents, 428 million. That is up about 50 million from the previous quarter. Do I have last quarter? Balance sheet quarterly. It was 365. It's 428. So, roughly $60 million. And I heard a space call last night, and I just can't believe, guys, major people that you guys know in this trade scratching their head saying, Must be good. The cash went up on the balance sheet in Q4. Things got to be good, right? Money comes in, big box office, Q4, cash goes up. Bills aren't due for 30, 45, 60 days. Of course, cash goes up in Q4. You're going to have a double whammy in Q1 because all those bills from Q4 are going to need to be paid. Plus, you have a low box office quarter. And that's why the company warns us in the 10K about working capital risk related to Q1. This is very predictable stuff. 5 years into this play, you guys should know this stuff. There shouldn't be a space call where people very big in this trade talk about Q4 cash went up. I don't, must be good. And not one person talks about Q1. I just don't get it. I don't fucking get it. Total revenues for the year, 4.8 billion, up slightly from 4.6. Net loss, 632 million compared to 352. I know that looks bad. I see all the bears talking about it. It's a lot of, look, I'm going to be harsh where I need to be harsh. I'm going to tell you, what I'm not super worried about if I'm not worried about it. The 632 million looks bad, but a lot of that was non-cash charges related to debt restructuring. So I'm going to give them a little bit of a pass on that. I am more worried about free cash flow on an annual basis than the net loss looking bad due to GAAP rule. But when we get down to free cash flow for the year, negative 365 million. This Q1 kills us every year. Even though Q2, Q3, Q4 were positive, Q1 last year obliterated this trade. And we're in the midst of it again right now. Q1 probably going to have it's going to be a major anchor on the rest of the year. So go freaking see some movies. That's all I can say. Let's see if got this call going here. Oh. Still got music. Let's see what questions you guys have. C12 Omega says, I still hold. I mean, you guys are grown up. I do have a new dashboard that I'm going to unveil on tonight's recap video, which, the old format looks something like this down here at the bottom. I kind of bucketize things into profitability, liquidity, financial efficiency, valuation, and other, and give it a weighted score. And we'll do this for every stock, just so you guys can see on a red, yellow, green basis how risky is the trade. When you have almost all red boxes, it's going to be a low score, extremely high risk, very speculative. That's not to say you should buy it or avoid it. It's just, if you want to understand how I'm analyzing a trade, these are the things I look at on the left-hand column. And if you're not looking at them, and you're just betting on a short squeeze, well, then you do you, boo. Do you.
To AMC's
all right, here we go.
Full year 2025 earnings webcast. With me this afternoon is Adam Aron, our chairman and CEO, and Sean Goodman, our chief financial officer. Before I turn the webcast over to Adam, I'd like to remind everyone that some of the comments made by management during this webcast may contain forward-looking statements that are based on management's current expectations. Numerous risks, uncertainties, and other factors may cause actual results to differ materially from those that might be expressed today. Many of these risks and uncertainties are discussed in our most recent public filings, including our most recently filed 10K and 10Q. Several of the factors that will determine the company's future results are beyond the ability of the company to control or predict. In light of the uncertainties inherent in any forward-looking statements, listeners are cautioned against relying on these statements. The company undertakes no obligation to revise or update any forward-looking statements, whether as a result of new information or future events. On this webcast, we may reference non-GAAP financial measures such as adjusted EBITDA and constant currency, among others. For a full reconciliation of our non-GAAP measures to GAAP results, please see our earnings release posted in the Investor Relations section of our website. After our prepared remarks, there will be a question and answer session. This afternoon's webcast is being recorded, and a replay will be available in the Investor Relations section of our website at amctheaters.com later today. With that, I'll turn the call over to Adam.
Thank you, John. Hello, everybody. Before I begin today's call, I'd like to make a personal comment if I can. As you undoubtedly know, in early December, upon my return to AMC's home base in Kansas City, I put out a press release which advised you all that just before Thanksgiving, during a business trip to London, I suffered a minor stroke. Fortunately for me, I got immediate care at a superb London hospital run by the United Kingdom's National Health Service, and it was envisioned that I would have a speedy and full recovery. There was no cognitive problem at the time of the stroke, no issue with reasoning or logic or decision-making or memory, other than that for a day or so, I completely lost my ability to speak. That was 14 weeks ago. You can hear for yourselves my voice today. My voice is back. I am delighted to report to you all that I am in fighting shape and fully ready to do battle. Speaking of which, let's talk about AMC. As we close the books on 2025, one thing is clear. This was a year of meaningful progress with AMC, both operationally and financially. While it is frustrating for us that the industry recovery unfolded at a much more measured pace than many, including ourselves, originally expected or hoped, even so, the trajectory clearly remained positive, and AMC once again distinguished itself through consistent outperformance, exceeding the expectations of many who doubted us. Even in a softer industry environment for the fourth quarter of 2025, where the North American box office declined by some 4.4%, AMC nonetheless demonstrated strength and resilience. For the fourth quarter, AMC generated approximately $1.29 billion in total revenue, $134 million of adjusted EBITDA, and notably $127 million of cash from operating activities. Along the way, especially our domestic U.S. theaters once again delivered with a 140 basis points of industry outperformance as we continued to capture increased market share. That's a testament to the strength of the marketing and loyalty platforms at AMC, the growing consumer preference for our industry-leading premium large format and extra large format offerings, and our commitment to deliver the very best in theatrical entertainment experiences. We believe that AMC has a powerful and commanding market lead. Our market share confirms that AMC represents more than 1 out of 4 of all the box office dollars generated in the United States. AMC is about 50% larger in size than the second or the third largest U.S. players, and everyone else in our highly fragmented industry has only a 1 or 2% market share, or even less than that. Sean will discuss our full year financial results in more detail, but let me point you to this. In 2025, continuing an improvement trend that has been the case for several years now, we worked so hard at AMC to make our company more efficient. Globally, our attendance in the full year was down 2.1%, but our adjusted EBITDA was up 12.7%. That's a striking contrast. And there's so much operating leverage in our company. I cannot emphasize this point enough. The operating leverage in our company is meaningful. Approximately 2/3 of the incremental revenue dollar drops down to the adjusted EBITDA line. So, if and when our revenues are growing, our adjusted EBITDA at AMC can grow and do so meaningfully. That's our expectation for 2026. No one's crystal ball is perfect, but most knowledgeable forecasters have the 2026 movie slate being considerably richer than that of the past 3 years, or for that matter, the past 6 years. And that is so vital because, candidly, the economic levels that we experience in 2025 are simply not sufficient to carry the day. But in looking to 2026, we are optimistic and we are confident. Disney and Universal have what look to be fabulous movie slates. Warner Brothers says that it will be releasing more movies in 2026. Paramount says that it will be releasing more movies in 2026. Amazon MGM says that it will be releasing more movies in 2026. Theatrically, even Netflix has the capability to be releasing more movies, and smaller operations like A24 and Angel Studios, among others, also seem poised to embrace theatrical exhibition with ambition. With an increased count of widely released film titles coming out in 2026, it is our firm expectation at AMC that the industry box office will grow markedly in 2026, that AMC's market share will remain compelling, and that the very real operating leverage inherent in our business will kick in such a way that it can cause dramatic improvement in AMC's financial results. 2026 has only just begun, but encouragingly, January was off to a strong start with the North American box office up approximately 16% compared to last year, and growth in the European market has been even more significant. Across the 12-month year ahead, the film slate is shaping up to be one of the most compelling in recent memory, anchored by an extraordinary lineup of films that can only be described as a parade of juggernauts that are ideally suited to AMC's industry-leading network of highly productive, high-grossing theaters. Based on the strength of the upcoming release slate, we believe that the North American box office in 2026 could increase by approximately $500 million to as much as more than $1 billion greater than was the case in 2025. And as I just articulated, and as previously reported, AMC financial results prove out to be true. With rising revenues, the growth in AMC's adjusted EBITDA can be substantial. I'm not going to take you through the list of 2026 movies title by title. That impressive cavalcade should play out during the year. Suffice it to say, though, that we expect to see a rising industry-wide box office in 2026, the biggest since 2019. And with the operating leverage of incremental revenues translating to incremental adjusted EBITDA, rising 2026 revenues bode well to engender a material and positive impact on AMC. I do want to be clear, though, that we will likely need at least a strong 2027 film slate as well, which we do expect, by the way, for AMC to be cash flow positive in outer years. But the considerable progress that we expect to make in this year, 2026, should fill us all with heightened confidence as to our future. Now let's turn from operating leverage to financial leverage and the improvements taking place within the AMC balance sheet. Strengthening the AMC balance sheet remains an extremely important strategic priority for this company. Since the end of 2020, AMC has reduced total debt by approximately $1.8 billion, including a $1.4 billion reduction in the principal balance of our outstanding debt and an additional $420 million repayment of COVID-related theater rental lease deferrals. During 2025, AMC continued to take capital markets actions to strengthen our balance sheet and prepare for the anticipated box office recovery that we think is coming this year. In July of 2025, we closed a series of transformative transactions, including receiving more than $240 million in cash from new debt issuance and the equitization of $183 million in debt, with the potential to equitize even more, up to a total of approximately $337 million. These transactions address all, I repeat, all of our 2026 debt maturities, pushing them out to 2029. In addition, just last week, we launched yet another transaction to refinance another approximately $2.4 billion of our debt. If successful, that refinancing will extend the maturity of that debt from 2027 and 2029 all the way out to 2031. Simply put, at AMC, we continue to do exactly what we said we would do. Take decisive action for AMC Entertainment to fortify our financial foundation, to bolster our cash reserves, and to enhance our flexibility. With that, I'll now turn the call over to Sean Goodman, our CFO. Sean?
Thanks, Adam, and good afternoon to everyone. As Adam noted, 2025 did represent a year of meaningful operational and financial progress. Although the industry box office did fall short of expectations, AMC performed exceedingly well in the areas that are within our direct control. For the full year 2025, the North American industry box office increased by a modest 1.5%, and industry attendance in the European markets in which we operate declined by approximately 3% versus 2024. Nonetheless, at AMC, we grew consolidated revenue by 4.6% versus 2024 to more than $4.8 billion, as we welcomed more than 219 million guests to our theaters across the globe. And we grew adjusted EBITDA to approximately $388 million, a nearly 13% year-over-year improvement, all of this in an essentially flat industry box office environment. We achieved these consolidated financial results with record-setting per-patron revenue and per-patron profit metrics. Admissions revenue per patron grew 5.9% to a record of $12.09. Food and beverage revenue per patron grew 5.1% to a record of $7.62. And total revenue per patron grew 6.8% to another record of $22.10. Importantly, our contribution margin per patron, this is defined as total revenue, less film exhibition and food and beverage costs, divided by attendance, this metric grew 7.2% to yet another record-setting $14.80. This measure of per-patron profitability is now 51% higher than in pre-pandemic 2019, underscoring the meaningful improvements that we have made to the business over the last few years. Breaking down our results by segment, starting with U.S. operations, we outperformed the North American box office, growing our admissions revenue by 3.9%, 240 basis points in excess of the overall industry growth. This outperformance helped drive total revenue growth of 4.6%, along with a nearly 15% increase in adjusted EBITDA. And consistent with the overall consolidated trends I referenced earlier, our U.S. theaters delivered record-breaking per-patron metrics for admissions, food and beverage, and total revenue, with total revenue per patron growing 5.3% to $23.79. In addition, the business generated a record per-patron contribution margin of $15.69, a 5.7% improvement over the prior year. Domestic total revenue per patron is now up 48% versus pre-pandemic 2019, and domestic contribution margin per patron is now up 56% compared to pre-pandemic 2019. Now turning to our international operations, note that the results are impacted by an increase in foreign currency exchange rates of approximately 4.5% year over year. With attendance at our international theaters down 5.5% versus the prior year, revenue grew by 4.6%, or was flat in constant currency, and adjusted EBITDA declined by 2.1%, or 10% in constant currency. Our international theaters also delivered record-breaking per-patron metrics for admissions, food and beverage, and total revenue, with total revenue per patron growing 10.6%, or 5.8% in constant currency, to a record-setting $17.97, and contribution margin per patron growing 11.3%, or 6.4% in constant currency, to a record-setting $12.61. Total international revenue per patron is now up 32% versus 2019, and international contribution margin per patron is up 37% compared to pre-pandemic 2019. Our results for 2025 reflect the effectiveness of our industry-leading loyalty programs, innovative pricing strategies, leadership in premium formats, and innovative food and beverage offerings, complemented by a relentless focus on the efficiency of our operations, and optimization of our theater footprint. In that regard, we continue to execute a transformation of our theater portfolio, negotiating more favorable lease economics, exiting underperforming locations, and selectively acquiring high-quality theaters that enhance our network. During 2025, we closed 21 locations and we opened 3. Since 2020, we've now closed 213 locations and opened 65 locations for a net reduction of 148 theaters, or roughly 15% of our portfolio. This ongoing reshaping of our footprint reflects our commitment to improve asset productivity, expand margins, and position AMC for sustainable long-term growth. Now let's move to the balance sheet. We ended the year with $428 million of cash. This excludes restricted cash. Our free cash flow for the year was a use of cash equal to $366 million. It's very important to note that this negative free cash flow was entirely related to the first quarter of 2025, and that for the 9 months ending December 31, 2025, we generated positive free cash flow of $51 million.
Right, but Q1's killing us, Sean.
Our traditional working capital cycle is closely tied to the seasonality of the box office. Generally, this has resulted in a positive cash impact from working capital in the second and fourth quarters, with a negative cash impact in the first and third quarters, the first quarter typically representing the largest negative cash impact. This pattern held true in 2025, and assuming similar box office seasonality, we would expect this cadence to exist in 2026. As Adam said, strengthening our balance sheet has been and will continue to be a top priority. This includes maintaining robust liquidity and continuing to pursue opportunities to extend debt maturities, reduce debt servicing costs, and decrease the principal balance of our debt. As Adam noted as well, we recently launched a refinancing transaction targeting our $2 billion term loan due in 2029 and our $400 million Odeon notes due in 2027. This new debt offering, if successful, will address the vast majority of our 2027 debt maturities, extend a significant portion of our debt maturities to 2031, simplify our capital structure, and reduce our debt servicing costs. In addition, we're also in the market with an at-the-market equity offering. Proceeds from the offering will be used to strengthen our balance sheet and also allow us to continue to invest in our core business to elevate and differentiate the movie-going experience for our guests. As of last Friday, we received $26.2 million of gross proceeds from this equity offering. Our capital allocation priorities are clear and consistent. First, maintain robust liquidity and strengthen the balance sheet. And second, invest in our core business to elevate the guest experience. This disciplined approach to capital allocation reflects our commitment to building an increasingly strong and resilient company to deliver long-term shareholder value. From a capital expenditure standpoint, our 2025 CapEx net of lease incentives totaled $200 million, exactly at the midpoint of our previously communicated $175 million to $225 million range. And we expect 2026 CapEx net of lease incentives to be between the same range of $175 to $225 million. Looking ahead, we see an exceptionally strong film slate in 2026 and beyond, and the operating leverage inherent in our business, coupled with continued success in growing that per patron revenue and per patron profit metrics, means that we are very well positioned to meaningfully increase adjusted EBITDA, improve free cash flow, and strengthen our balance sheet with the box office growth that is anticipated in 2026 and beyond. And with that, I'll turn this call back over to Adam.
Thank you, Sean. Our 2025 results and our optimism for 2026 underscore that AMC remains firmly playing on offense, focused on bold strategic initiatives that elevate the moviegoing experience and reinforce AMC's position as the clear leader in theatrical exhibition. 1 year into our forward-looking AMC Go plan, the results are both tangible and encouraging as AMC continues to delight our guests and AMC continues to position ourselves for sustained growth in 2026 and beyond. As one example, laser projection with its brighter, sharper screen images now exists in fully half of our U.S. theater circuit. And how can we not revel in the leadership position that AMC enjoys in the availability of premium large format and extra large format screens? As you know, they command sizable price premiums, and they're about 3 times more productive than a standard screen. It's no accident that AMC has more premium large format screens and more extra large format screens than any other exhibitor on earth. So it's obvious why we are so glad that our count of IMAX screens and our count of upgraded IMAX with laser screens is growing. That our count of ever so popular Dolby Cinema screens is growing. Ditto that with CJ's ScreenX and 4DX offerings, as well as for increases to the numbers of our Prime and iSense house brand PLF offerings. I am especially pleased, too, by the story surrounding AMC's XL, or extra large format screens. They were created out of thin air and piloted by our Odeon team in Europe less than 2 years back, and given their success, we now are expanding the reach of XL broadly across our U.S. theaters as well. We now have just right around 170 or so XL screens globally, and I would expect that that number will literally double by the end of 2026. Moving beyond the auditorium, our world-class AMC marketing and loyalty programs continue to evolve smartly in 2025. In January 2025, we introduced a new successful AMC Stubs loyalty tier called AMC Premier Go that allows consumers to trade up to Premier status or a modified Premier status through increased patronage at our chain without having to pay an added fee. That's taken our member enrollments all the way up to some 39 million households in the United States, accounting for an impressive 51% of our total U.S. attendance during the year, playing for points in our frequent moviegoer loyalty program. That level of engagement not only deepens guest loyalty, but also provides valuable insights given our extensive database containing as it is a myriad of purchase transactions guest by guest that enable us to smartly and more targeted basis create marketing efforts to our best customers on an ongoing basis. Another important pricing action within the scheme of our loyalty program was price increases, considerable price increases in our A-List loyalty program, subscription program that occurred in the month of May. And while those are examples of price rises, with a keen focus on having raised prices during peak demand periods and to the most frequent of our guests, it is also true that AMC simultaneously has remained committed to appealing to the value-conscious consumer as well. So, in July of 2025, our marketing team reimagined our long-standing Discount Tuesdays program by launching an intriguing and attention-getting new 50% off Tuesdays and Wednesdays initiative. Importantly, our analysis shows that the incremental attendance generated on these 2 weekdays now has not cannibalized our weekend attendance, and to the contrary, has increased the business generated in our theaters midweek, an outcome that benefits both AMC and our studio partners, and of course, benefits the movie-going public in addition. And we did not stop there. At the end of 2025, we introduced the AMC Popcorn Pass to our loyalty members, an innovative annual offering that allows AMC Stubs members to enjoy 50% off pricing all year long on a large AMC Perfectly popcorn for a one-time fee of $29.99 plus tax per year. In only the first 2 months after launch, more than 120,000 guests have already paid us this $30 fee for a popcorn pass. Beyond delivering exceptional value to the guest, the popcorn pass also encourages more frequent theater visits and deeper guest engagement. If those were things that we did in 2025, I would like to tease you today with one of what I think will be one of AMC's best new marketing ideas for 2026. Later this year, AMC will introduce preferred, so-branded premier seating, where we will block and reserve the best seats in the house in our theaters to be accessed first only by our A-List and our Stubs premier members. That's the 2 VIP tiers within our Stubs program. At no added charge, at AMC, we will assure that the best seats in our auditoriums are held out only, at first anyway, for our best customers. We think it will be a considerable consumer benefit that our most frequent guests will notice and greatly appreciate, further cementing their brand loyalty to AMC. There are 2 other things I'd like to highlight before turning this call over to your questions. First, you may recall that a few months ago, AMC and Netflix made the joint decision to partner together. This was a significant departure from our 2 companies staying at arm's length from each other over a period of many years. That effort started in bringing Netflix's popular K-pop Demon Hunters to AMC theaters over the Halloween weekend. That collaboration between AMC and Netflix proved highly successful, with AMC delivering to Netflix approximately 35% of the film's total attendance during that holiday weekend timeframe. Building quickly on that momentum, our dialogue with Netflix continued, resulting in AMC's hosting the series finale of Stranger Things in some 231 AMC theaters across the United States over New Year's Eve and New Year's Day. The response to that AMC Netflix offering in theaters wildly exceeded all of our expectations. We initially only put on sale about 105,000 seats or so, but when it was all done a month later, AMC had the privilege to welcome more than 753,000 Stranger Things fans, collecting approximately $15 million in cash from Netflix fans watching the Netflix product in an AMC theater. In just 2 days, it was a powerful demonstration of the demand for shared theatrical experiences tied to culturally significant content. The success of our recent collaboration with Netflix highlights the strategic opportunity that lies ahead, and I am certain that we'll have more adventures together cooperatively with Netflix. With roughly 2/3 of AMC Stubs loyalty members also subscribing to Netflix, the audience overlap between our two companies is both significant and compelling. As a result, our two companies should be the best of friends. And I can confirm to you that AMC is enthusiastic about the prospect of expanding our relationship with Netflix. We look forward to working together to create innovative, mutually beneficial theatrical events that drive value for both companies. The second thing that I'd like to mention before closing, with the recent meteoric rise in the share price of Hycroft Mining Company, I could not be more pleased to report to you that our investment in Hycroft has met and exceeded attractive financial hurdle returns. In November of 2025, we monetized just more than $24 million from a partial sale of our Hycroft stake. But importantly, at the time, we said that we would retain a significant number of shares and warrants to continue to experience upside. Those remaining shares and warrants in Hycroft are worth right about $39 million at today's market closing price. So that $63 million or so in total compares quite favorably to the $29 million that we invested in Hycroft 4 years ago. For those of you who scoffed at our Hycroft investment at that time, and there were many of you, you were wrong and we were right. As we conclude, AMC's resilience continues to set us apart. While the industry recovery has progressed more gradually than anyone might have originally anticipated or wished to see occur, even so, AMC has remained agile, disciplined, and firmly focused on long-term value creation. AMC has demonstrated our ability to navigate a dynamic environment, some would say an extremely difficult and challenging environment, but all the while we did so, we also strengthened our competitive position and we emerged poised to capture gain from the opportunities that we believe are ahead. That our opportunity is now at hand. We expect the box office to rise in 2026. And please remember from this call the two most important words that are relevant to AMC: operating leverage. An increase in our revenues in 2026 has the prospect of leading to many a smile as we watch our adjusted EBITDA levels as the year unfolds. As we have had to say far too many times over the past 6 years, we are not out of the woods yet, and there are challenges ahead still. But the signposts for 2026 are indicating a significantly strengthened year ahead. With that, let's turn the call over to our operator to poll analysts for their questions from equity research analysts. And then, Sean, I'll give the podium to you, and you and I will review some questions submitted by our retail investors.
Thank you. If you'd like to ask a question, press star 1 on your keypad. To leave the queue at any time, press star 2. Once again, that's star 1 to ask a question, and we'll pause for just a moment to allow everyone a chance to join the queue. Thank you. Our first question comes from Chad Beynon with Macquarie. Please go ahead. Your line is open.
Hi, good afternoon. Thanks for taking my question. And Adam, great to hear that you're feeling and sounding much better here.
Thank you.
Wanted to ask, I know, Sean, in the prepared remarks, you talked about the screen or the theater count reduction in 25 and in the past couple of years. How are we thinking about your fleet or portfolio at this point, given the strong outlook for content in 26? And then related to that, are there expected to be any new builds that are in that CapEx number? Thanks.
Hey, Chad. As I said in my prepared remarks, we've done significant activity closing over 200 theaters over the last 6 years and opening around 65 odd. We will continue to take actions to close theaters, to reduce leases as we go forward. About 10% of our leases come up for renewal each year. So it's about 85 leases coming up for renewal. And each time these leases come up for renewal, we have that opportunity to improve our overall theater economics. You know, the theater portfolio has improved significantly over the last 6 years. It's one of the reasons that our per patron metrics and our per patron profitability is so much higher than it was before. But we believe there continues to be a very significant opportunity. You know, like most organizations or companies with a retail footprint, our theaters are a kind of normal distribution, and there is a tail of underperforming or loss-making theaters. And we see an opportunity to close those theaters or renegotiate leases and then take on new theaters that are significantly, very significantly more profitable. So I think you're going to see the similar sort of pace going forward. We'll be closing more theaters than we open, but the new ones that we open are generating significantly more profit than the ones that we close. And to your question about sort of the CapEx level, there'll be a small number of new theater locations in 2026 and going forward, and that is included in our CapEx projections in the $175 to $225 million range.
You know, I might add that, like everything we've been doing smartly over the past few years, we've been capital light. So you specifically used the phrase new build theaters. New build theaters are considerably more expensive than what we call spot acquisitions, where we can take over a theater where most of the capital has already been spent, and we maybe pop $500,000 to $1 million just to upgrade it and bring it into the AMC fleet and apply our marketing programs and our product experiences and expertise. And when we've done this in the past, we've seen substantial rises in the revenues of the theater and the efficiencies of the theater that we've taken over. So, as Sean said, I'm sure we'll close some underperformers, which makes us money. It doesn't cost us money. And we'll probably add a handful of spot theaters, spot expositions as well.
And maybe it's worth pointing out the example of the Grove, right, which in Los Angeles that we took over as a spot acquisition. And that theater used to be number 28 in the country in terms of annual box office receipts. Now, with adding the AMC Secret Sauce, that theater is now number 5 in the country in terms of receipts. And that's just one small example of the benefit that we bring and the attractiveness of AMC as a tenant for landlords in their developments.
Okay, great. Thank you both for that. And then my unrelated follow-up, I think you mentioned, most are expecting the U.S. box office to be up somewhere between 500 million and $1 billion. I think that's where most analysts are, in this high single-digit, low double-digit growth rate. International is a little harder for, I think, us in the industry to pinpoint. Do you have a gut feel if international admission revenues could be higher or lower than kind of what we're seeing in North America this year? Thank you.
Well, we've completed 7 weeks, or 8 weeks, almost 8 weeks of 26, and we know already that Europe is recovering faster than the United States from the 2025 box office. So if I had to be a betting man, we'd say Europe is going to be stronger than the U.S. And some of you like to report in constant currency, and some of you like to report as the dollars come in. The dollar's been pretty weak, which means that our overseas revenues and overseas EBITDA is coming back in U.S. dollars in even stronger levels. So this could be, year over year, this could be Europe's best year of the last 6.
Okay, great to hear. Thank you very much. Appreciate it.
Thank you. I'm showing no additional questions at this time. I'd like to now turn it back to Sean Goodman for retail shareholder questions.
Thank you, operator. Adam, we have a couple of questions here. Firstly, relating to the food and beverage business. As you and I both know, our food and beverage per patron numbers have just been spectacular post-pandemic. And I think there's really exciting opportunities for us ahead there. But the question is sort of what future changes, innovations can people expect on the food and beverage side?
This is really important because if you look at why this company has been able to navigate really turbulent waters over the past half decade, our strength in food and beverage sales has been a big reason. If you look at our contribution per patron, it's up not quite 50%, but almost 50%, which means that we don't actually need the box office to recover all the way back to 2019 pre-COVID levels. And that's a direct result of beverage success. I think at this point, there's a lot of finessing that's going on within our food and beverage operation, where we're using menu experimentation to please the guests and help our bottom line. As one example, we just introduced in the fourth quarter of 25 freshly baked chocolate chip cookies which not only taste great but smell great in the theater lobbies. And they replaced donut holes, which were not selling as well at our concession stands. We just introduced at our dine-in theaters a much better pizza than we've had in modern memory. It looks like real pizza. It tastes like real pizza. It is real pizza, and it's really good. I've tested it myself in the kitchens, and I'm a pizza buff. But so those are two examples. And another thing that's really important, though, of what's happened in our concession stands is not what you eat, but what you buy. 3 years ago, AMC didn't sell essentially any movie-themed merchandise. And our movie-themed merchandise now has become a sizable business for us. In 2025, it was $65 million in the United States, another $10 to $15 million in Europe. This was a business that didn't drive literally a penny of revenue or EBITDA 3 years ago, and it's now doing $80-ish million of business today, and the profit margins in this thing it's about 50% or so margin business. Like, that's substantial. And I think this movie-themed merchandise business is poised to grow again dramatically in 2026. I wouldn't be surprised if it grows by 20% or more as we enter our fourth year of successful effort in and around our concession stands in our theaters.
So there's a lot going on in the industry at the moment, and there's questions about, just for you to comment on our relationships and relations with studios, what's going on with Windows, update on union negotiations and the potential for a strike later this year?
Sure. Well, when you talk about what's our relationship with studios, it sure helps when you sell more movie theater tickets for every single studio than anybody else on earth, especially if you combine the ticket selling in quantity with the amount of effort that AMC devotes to our studio interactions. I can say with confidence that AMC enjoys a very strong special relationship with each and every studio, every single one. We think highly of them because our lifeblood depends on it. And I believe that they think highly of us because that they know at the end of the day, we're going to outperform for them above everybody else. So in terms of studio relations, it's all great. An interesting development when I think of studios is not just the traditional studios, the majors, but we've had surprisingly good interactions of late with some of the streamers who historically were not major theatrical exhibitors. Last year, we had real success with Apple in their film F1. We leaned into it in a big way. We were very successful with the film. They were very successful with the film. We appreciated our relationship with them. I know they appreciated this support that we put forward. I'm looking forward to big things coming from Apple Original Films going forward. Amazon is now telling us that their goal is to release 15 theatrical movies in 2027, and that they'll probably get up to 10 to 13 theatrical movies on their slate in 2026. That's news. Amazon MGM was only good for a movie or two 5 years ago. They've become a real player in Hollywood. And then there's Netflix. We had this September meeting where we sorted through how we could work together and that it would be advisable to work together. And the first two efforts out of the chute were extraordinarily positive. I know that we're excited about doing more with them, and I know that they were pleased with AMC's effort on their behalf towards the end of 2025. You mentioned in your question union negotiations. For good or for bad, we're not a party to those union negotiations. We have a vested interest in their outcome, but we're not at the table. I do know that the studios have taken these negotiations seriously. They've started the negotiation process earlier than they did last time around. I think the general consensus is that the two strikes a couple of years back were devastating to everyone connected to the movie business, devastating to the members of the union, devastating to movie makers. I would sure hope that we don't have to repeat anything like that, and that the union studio negotiations transpire in such a way that deals are met and that the production of movies goes on without interruption.
And then our final question here is on CapEx spend. We've guided to 175 to 225 million a year, which is the same in 2026 as it was in 2025. Just questions on how we're allocating our CapEx spend, sort of what are the focus areas for our CapEx spend?
Well, in very round numbers, right? Very round numbers. 150 million of that number is what I'll call maintenance capital to keep our theaters in good shape. Roofs not leaking, HVAC systems working, IT systems being overhauled as needed to continue to have AMC be a strong player from an IT standpoint. AI is capturing some of our money now because there are ways to make our company more efficient through the adoption of AI techniques. Beyond that, though, in a capital light way, we continue to be very committed to upgrading the theater experience. And we're going to add more IMAXs. We're going to add more Dolby Cinemas. We're going to add more Primes and iSenses. We're going to double the number of XL screens. This is all good. At the same time, a decade ago, AMC was quite experienced and practiced in renovating whole theaters expensively, ripping out seats, putting in the so-called recliner seats, which are very popular with guests. But we have a problem. And the problem is we have a number of theaters where the volumes are so high that we can't afford the seat loss of pulling a lot of seats out of the auditoriums. It reminds me of the old Yogi Berra quote, "Nobody goes there anymore because it's so crowded," he once said. So it was easy to decide, how do you renovate a theater if you got to rip everything down to the studs and put in recliner seats with 6 feet of leg room per row? But now we're at a point where that's pretty much behind us. And we're looking at how do we keep the product top flight in some of our highest volume theaters where more traditional seating is going to be the norm. And we came up with what we think is the answer, And interestingly, Sean, it's also a capital light solution. We had a theater in Burbank that was the single highest grossing theater in the United States, but it was in kind of ratty condition 2.5 years ago. The seats were tired and old and stained, and we knew we had to replace all the seats at the Burbank Theater, but we also knew that the volumes were so high at the theater, we were going to need a similar seat count to what we had at the time. So a lot of studies, we investigated dozens of different potential seats, and we came up with what is now, if you look at our website and app, is branded as the AMC Club Rocker. It's a very comfortable seat and much superior to anything that's in our traditional seating theaters today. It's kind of a leathery look. I'm not sure it's actually leather, but looks like leather, it feels like leather, it smells like leather. It's got a lot of padding and cushioning. It's wider than the older seats, and it rocks. It moves around a little bit so people can adjust the seat to their own comfort. And it was a massive hit when we put it in to Burbank 16. So we took that same exact seat and we put it into our Empire Theater in Manhattan, in our Lincoln Square Theater in Manhattan. And week after week after week, I was seeing in our reports that of our 550-ish theaters in the country, the 3 highest grossing for AMC were Burbank, Empire, and Lincoln Square. Week after week after week. What did they have in common? The Burbank seat. We have since put it into some of our other theaters. For those of you who are knowledgeable about a theater on the Upper East Side in Manhattan called Orpheum 6, we're going to put that seat into Orpheum 6 sometime this year. We're going to greatly expand the legroom to 48-inch seat pitch, which is a lot. I love to say 4 feet for your 2 legs. And the combination of a lot of legroom and that very comfortable new Club Rocker seat is going to turn that theater into what is now a tired, substandard old Lowe's theater from ages ago, into a real powerhouse on the Upper East Side. And we're also going to look to take that Club Rocker seat into others of our theaters as well. And it's a very inexpensive effort to redo a theater and make it nice, but do so in a smart, capital-light way. So those are examples of where the money's going. There was an earlier question about will we just contract theaters or will we add some? We will do both. So when we take over a theater, we might spend $500,000 or $1 million to bring the theater into our system if it's in relatively good shape. If it needs a little bit of renovation money, maybe we will work with a theater landlord to jointly put up $2, $3, $4 million to bring some theaters into our fleet in very good condition. Hopefully the landlord would pay a significant chunk of that cost through tenant allowances and the like. So that's another thing that's going on within the CapEx budget. But as you said, we've got a fairly tight constraint. A couple of years ago, we were spending $450, $500 million of CapEx. We believe that rounding to the $200 million range is something that we can, plus or minus 25, is something that we can do going forward in the near term. So that's the update.
And that concludes the retail investor questions for today's call.
So let me just end the call by thank you all for listening to us today and participating with us. It is going to be the strongest slate of moviegoing that this industry has seen since 2019. The year is starting up in double digits, which is a nice way to start. And I leave you with this one thought that's dominating our thinking and my comments on this call, that notion of operating leverage. As revenues rise, EBITDA rises, and it does so at a geometric pace. So we won't be all the way to where we need to be at the end of 26, but we expect to make a dramatic amount of progress. So this should be a year that makes us all smile. Thank you for joining us today. See you at the movies.
Thank you. This brings us to the end of today's meeting. We appreciate your time and participation. You may now disconnect.
Try not to get a YouTube strike from that damn music. All right, some of y'all are asking about the price. So, and we'll go through a couple of questions and then maybe come back later tonight for another live stream. Let me get rid of this. Could the price go lower than $1.17? I'm going to show you guys right now the same thing that I told the Discord some time ago, what I'm looking at. See this red line? This was when they announced the ATM offering. And then a year ago, same thing, right? The red line. And then the yellow line, 6 weeks later in January of 2025 is when they completed the ATM portion of the offering, but there was still the forward collar, right? They sold, what was it? Like 60 million in an ATM, about 10 million a week last year. And then they had another 100 and something million, 140 million in the forward collar. And we're on the same path right now, $10 million being sold per week. How do I know that? Because in the press release, they said they've sold so far 20 million shares, $26 million. So roughly 10 million. We're roughly on the same path as here. But here's what I'm worried about. Just me, I'm not trying to scare you. If I look at the trajectory of what happened in that 6-week period, it got run down. And then there was a long period of just very slow selling. They didn't tank the price. And then all of a sudden, bloop, the last few days, it dropped from $4 to $3.25. At a 25% drop in the last few days of that ATM offering. And then because of the forward collar, price went all the way down to $2.45. Forward collar, bad Q1 cash burn, what have you. It's hard for me to say, but there were many moving pieces going on. So are we going to have this extended period here where we kind of trade sideways and then have this huge rug pull at the end of the ATM? I don't know. I think AMC could sell the shares slowly, or they could say, we need the cash right now. We got bills to pay, and they could dump them and tank the price. Remember, AMC is in charge every day of saying how many to sell and at what price. And that is largely driven by their Q1 cash needs. The entire reason they're doing this 150 million ATM is there will be a considerable cash burn in Q1. I was going through my spreadsheet and my free cash flow forecast. and putting in all the Q4 numbers and looking at Q1 again. And I'm still thinking, we will be lucky in Q1 if the free cash flow burn is 300 million. And they got what, 460? Plus they're going to raise 150. So that'll keep them around 300 million. But the timing also of when are those bills due? If you're burning 300 million, when are those bills due? That kind of drives how fast they need to push this ATM. They are doing the ATM because of cash that is being burned right now due to Q4 bills. Accounts payable are now being paid, and we have low box office. It's just a timing thing. It's all companies that are movie exhibitors are dealing with this. Q4 looks great, cash flow wise. Operating cash flow looks good. Free cash flow looks good. Q1, the piper's got to be paid. And I know people get really angry at me for talking about this stuff. Why don't you talk about Q2 to Q4 being cash flow positive? Yeah, they probably will be again this year, just like last year. But it's the freaking Q1 that is killing us, guys. It ruined the whole year in 2025. Q1 torpedoed the year for free cash flow. Let's just look at it. Top screen. I'm not saying this to break your spirits. I'm saying this to teach you what everyone else is ignoring or calling FUD. Free cash flow in Q1 last year, 417 million. Q2 and Q3 balanced each other out, right? 88 positive, negative 81. And then Q4, we had a positive, just reported 43 million. So Q2 to Q4 were positive by about 40 million. But negative 400 million just incinerates the year. Doesn't matter if Q2 through Q4, oh, big fucking deal. 40 million positive, who cares? But watch, everybody else is going to be, they're going to shift real quick to this. Let's not talk about Q1. That's fuddy. You talk about Q1, or if your friends, you follow anyone on X who talks about Q1, I'm going to block you. You better get your head out of the sand. Because we're in Q1 and there's going to be a cash burn. 417 million last year, 238 the year before, 237 the year before. I'd be ecstatic if it was only 200 million. I'd be ecstatic. But that's only going to change if you guys go see movies. We need high box office. What was the Q1 box office these other years where the cash burn was 202? That would be 2024, 2023. Q1. 1.7 and 1.6. So if we can get up to 1.7, we maybe only have cash burn of negative 200, negative 250. That'd be a lot more palatable, right? And then you add in 150 million cash raise, you keep the majority of your cash from Q4. We got to get to this point, 1.6, 1.7, this quarter right now. You have to go see movies. Not just you. I mean, I can't do it. I'm watching 2 or 3 a week. I can't do it alone. Even all of us together can't do it. But America needs to go see movies, and the Hollywood needs to put out movies that people want to see. If you, someone said, let's just keep buying overpriced popcorn. Look, I mean, you don't have to. But I don't know why you'd own the stock if you're not. What's your game plan here? You're not going to go to movies. You're not going to buy overpriced popcorn. You're just going to hold a stock that's getting diluted because of losses. What is the game plan? I hear people on X having space calls saying, don't listen to these people telling you to go to movies. Buy the damn stock. If I have $20, I'm going to a movie. I'm not buying the stock because my $20 of buying the stock is going to be worth less in a few days. And I got no utility out of it. At least if I go to a movie, that's part of my entertainment budget and our family budget. What are you going to do? Go to the bar, go to a movie? You get to choose. But if you're not allocating some of your entertainment budget to movies, popcorn, and then you're complaining about the stock price, like you're part of the problem, literally. You are part of the problem. Anya says you could buy a shot of Patron each movie. I had a dirty michelada at the movie last night, Anya. I had 2 micheladas and I did the dirty michelada for the second movie because I watched 2 movies last night. $41, including tip, or $42 for a beer with a shot of Patron. $42. Woo! The things I do for you guys. I don't even own the damn stock. Dave says, what is your forecast for March box office? Dave, I am in the ballpark that we will finish up Q1 box office. I mean, if I hedge my bets, I'd say 1.5 to 1.7 billion. But I think higher probability is we will come in 1.6 to 1.7. What do we got? 5 weeks left. And we need 500 million. We need $700 million in 5 weeks. We got some good movies coming out. It's doable, but it's going to be down to the wire again. The 3 or 4 remaining good movies starting this weekend with Scream 7. I am estimating 400 million for those 4 movies together. So between those 4, that gets us to 1.4 billion by end of March. We need all of the smaller movies to contribute another 200 million in the next 5 weeks. That's your bet. What is the AMC box office? Let me check. You can see, just for fun, here in 2026, I plugged in a couple of different box office numbers. 12 billion. We're not going to do 12 billion. Wanted to see what it would look like. 10.3 billion, 9. And 10.3 billion gets us very close to break even. About 10.4, roughly, would get us to break even on a GAAP earnings, right? AMC will be profitable for GAAP earnings. You have things on here that are non-cash expenses. You don't need 10.4 to be free cash flow positive for the year. You do need 10.4 to make the year look like you had a profit on earnings per share, net profit on the income statement. But remember, there are some non-cash stuff on here. $265 million is depreciation. $43 million is impairment. So I don't know. I should probably run the numbers and see what do we need in box office to be free cash flow positive on an annual basis. That's really what we want to know, right? I'll try and do that before my wrap-up video. Mr. Duck says the shorts don't even need to have AMC go bankrupt. They just need to get it delisted. Rocky says, don't listen to the apes. Keep talking about it. I mean, anybody that doesn't want to know about Q1 already has me blocked, Rocky. Every major pumper out there, I use the word lovingly, AMC fanatic. Look, I wouldn't say I'm a fanatic because I'm not out there every day telling you I'm buying the stock or you should buy it. You should go see movies if you own the stock. I'm just a patient investor waiting for the bad news to get out of the way so I can come in and get a cheap price. Like, there is a chance soon that I could be going long again, but I got to get this risk out of the way. The risk I've been talking to you guys about for 15 months when it was at 556 and now it's at 117. And think of all the fucking shit I've had to deal with for the last 15 months from these knuckleheads. I would be really angry with myself if I watched my position of AMC, me personally, get whittled down from almost $6 to $1.17. No, I got a family to take care of. I have a love relationship with my portfolio. Portfolio comes first. You don't abuse your portfolio by holding it into the red when your DD says that things aren't looking good due to not enough box office, not enough cash, out of shares. That's what my DD said. That's what I've been talking to you guys about 15 months. Not because I want to influence your trades. I'm just being one different voice, telling you what I'm looking at, what I'm doing, what I'm waiting for. And like I have told many people recently, the chess players are still moving the pieces around. We know now Pentwater is out of the trade. Good riddance. All these knuckleheads telling you Pentwater was bullish. BS. Now they're saying, now that Pentwater, they got rugged. They rugged themselves, these promoters on social media. Now they've flipped. Oh, look at Discovery Capital. That's bullish. No, BS. Discovery Capital is not bullish. You're going to get a filing that says they own 0 shares. It might not be this week. Might not be this month, might not be in Q1, but they are going to dump those shares. And they're not holding them for a MOAS. They have a pre-planned strategy, and they have almost no risk. All I can do is teach. It's up to you to listen. Some of y'all are going to get mad and say, fuck this. But I will be right. Mark my words. How do I know that? And watching Discovery and Pentwater for years. This is nothing new. They keep getting shares. They keep selling them. Sometimes very quickly and always at a profit. Doesn't matter what the share price is doing. These motherfuckers are the ones shorting it. They're already up 100%. Then they're going to get shares. They have a structured, almost risk-free trade. These hedge fund lenders that are buying the exchangeable notes. They're not dummies. And it is unfortunate that AMC is kind of stuck in this distressed position, and that's all they can get. Stressed money lenders. It's not a plan by AMC to tank the stock. It's a desperation move. Here, Adam, we'll give you 200, 300, 400 million, but this is what we want. We want convertibles. We want this conversion price. Yada, yada, yada. Look, these guys aren't dummies. The hedge fund lenders, they are setting up a profitable trade for themselves. And it took me a while to figure all this stuff out, but I'm not a fan of any of these lenders. AMC would be bankrupt without them, so I'll give them that. But they're not on our side like you think they are. They're on their side. That's it. They're looking for a profitable trade, and they know the plan before they buy the bonds. Vin Cool says AMC is in a doom loop. Someone asked me that. Are we in a death spiral? I'm not saying that AMC is in a death spiral. Because they don't have a SPA agreement. They don't have preferred that can be converted to common. We have a little bit of exchangeable notes out there. So we know what the dilution risk is. I'm going to be watching very closely the new debt that they're restructuring right now, $2.4 billion. I don't want to see any convertible debt in that. The more convertible debt that is out there, you start running this risk of getting into a dilution, debt-driven dilution death spiral. But there's no debt reason once these exchangeable notes are behind us that they go in a death spiral. There is the liquidity risk created by box office, particularly in Q1. But we're almost done with Q1, so maybe the bad news is almost behind us, and then Q2 through Q4 will be free cash flow positive. Maybe they sneak through. And then we start, I don't have any firm call on 2027 yet. They say it's going to be better than 2026. What do I know? I'm not talking to the studios every day. So I will assume that is the case for now until we have other information. Vin Cool says, I have little understanding of how the price could recover. Well, see, that is it's a good concern. Someone asked me in the chat earlier, how, what do I think the price is going to be at later this year? Oh. How many shares are they going to issue? We're at 513. What did they tell us in the press release in the 10K? All but 270 million of the new 550 are already spoken for. That's like almost 300 million shares. I mean, you guys are watching the market cap go down, but you're not thinking about the share count going up that is soon going to be reported. And so the market cap is not really 600 million in my mind. We're at like 900 million if I factor in all the shares that are going to be turned in through ATMs and exchangeable notes, probably at 900 million on market cap. But it'll be a period of weeks before all of that is revealed. Weeks, maybe months, depends. Am I saying it's a wrap and all is lost? No. I just said there is a good chance that I will be going long here once all of the chess pieces are finished being moved around. They're not done yet. There's still an ATM in progress. Look at look at the price action last year. At the end of the ATM. I just am sharing this with you so you know what I am worried about. Why am I hesitating? Tony, doesn't 117 seem really good? Yeah. What if this flat zone for a month is this year's 117? And then the last 5 days, we're going to drop to 95 cents? I don't know. I'm not going to get in front of a corporate action. A lot of y'all are. That's your choice. Tony, what happens if everyone copied you? Not everyone's going to copy me. Don't worry about that. I'm taking care of my money, taking care of my portfolio. There's going to be a lot of people that don't care about risk. They don't care about being in the red. I care. So we could have a period of weeks where we just trade here. And then it could go up. Could have that tail down. How fast is AMC going to sell the shares? I don't know the answer to that. Therefore, while the pieces are still being moved around on the board, I'm going to choose to remain cautious out of the trade. I don't need to get the bottom penny. It's 115, if it's $1.07, if company that maybe the ATM's done. I want to have a better idea what how bad the cash burn is going to be in Q1. I know some of y'all are worried about a reverse split. I'm not talking about that on social media. We talk about it in the Discord. But I think, a reasonable investor would at least have that in the back of their mind when we're mapping out all of the potential things that could go wrong. That's one that could go wrong. I'm not predicting a reverse split. I'm not warning of one. There are people in my Discord that are warning about it every day. They're convinced it's coming. I'm not saying that. But I think you should factor it in to a risk-based analysis as one of several possible outcomes. And I see DC is asking, is there a risk of the reverse split? Yeah, there is a risk. What I told the Discord is, I can't say that it's 100% probability because I don't know what the company's motivations are here. Are they going to feel some pressure to raise more cash, or are they going to just, all right, we got 150 million. We're going to be fine for Q1. Cash flow positive in Q2. We're good. Let's just tiptoe our way through and we'll try and make it. Are they going to do that, or are they going to be a little more concerned about getting more cash on board? That's a judgment call. That's a judgment call for you, for me, for everybody else. I have observed Sean Goodman to be very aware of liquidity risk and very willing to do whatever he needs to do to mitigate that risk, which is why I told you guys there would be a cash raise in Q1. And Why we said the same thing last year. Option Trader says, Tony, you should use your AMC time on Tesla. Yeah, I mean, I trade Tesla every now and then. If there's an audience out there that is trading Tesla, whether it's swing trade, options, or long-term holds, or even just doing valuations, I've thought about pivoting to that a lot, many times, but why do I keep covering AMC and GameStop? Because there's so many people putting out what I consider to be misinformation. It doesn't mean that you need to avoid the trade. That's your choice. But if you're going to be in the trade, you better fucking understand it. And the reason people keep losing money is they are not getting good information. They're not getting good expectations. They're not getting proper explanation of the financials or cash flow forecasting. They're getting the rainbow and unicorn treatment. And that shit kind of pisses me off. And the more they complain about me, the longer I'm going to be here. Maybe if y'all would start doing honest coverage, I could move on to something else. Y'all, everybody else on social media, but they won't. Meanwhile, you know, I'm not negative on the trade. I'm a A-list member, popcorn pass owner, 2-3 movies a week. I own other cinema stocks. One guy in the comments, he's like, "Oh, you own Cinemark. Now you're exposed. Everything you say makes sense." I don't care if you buy Cinemark. I don't go to Cinemark movies. I go to AMC. But I'm up 20% on Cinemark. I'm up on Marcus Corp. And that money's parked, making a profit while I'm avoiding losses in AMC until I decide that AMC is a point where I might want to move some of that money back. But I'm not going to do it and just watch it melt away for the last 15 months. So I'm sorry if me making money in a different ticker while I'm paying very close attention to this industry and the movies, I'm sorry if me making money in other tickers hurts your feelings. I've been talking about my trades every day for years. This is not any secret. And if you're such a child that me making money in other cinema tickers while I'm waiting on AMC, if that hurts your feelings, I don't want to talk to you anyways. You're not the type of person that we want to hang out with. I'm looking for people looking to learn, understand what's going on here, learn to predict. And more importantly, buy cheap and sell into run-ups, not the other way around. We don't want to buy high and sell out of desperation because it got walked down 90%. That's like the opposite of what we want to do here. Yeah, and JJ says, don't put all your eggs in one basket. I preach on that a lot, JJ. Diversification, diversification, diversification. Does that mean I want you to buy AMC and GameStop? Hell fucking no. 2 stocks is not diversification. 2 speculative stocks is not diversification. Diversification means picking profitable companies with growing revenues. That right there takes AMC and GameStop both out of my solid trade bucket. GameStop has falling revenue. They're highly liquid, highly solvent. I do own GameStop at a price that I'm happy with, around $20, because I think they're going to do something with the cash, but it's a falling revenue stock. I would never tell you go all in on GameStop. Once they announce some news, it's easier for me to say that. Right now, you got to take your own leap of faith. It's not my job to convince you to buy a speculative ticker. I have no idea what or when Ryan Cohen's going to do with that money. So that is your bet. I am in the bet. I'm not going to live stream every day about it, trying to convince you to do that. Andrew says, come on, optimism. Here's the optimism I got for you, Andrew. I have some good expectations for Q2 through Q4. And if they drop more movies into the mix, I've done my forecast now based on what we know about now. If they drop even more movies in, it only gets better. I know it sucks hearing me talk about Q1, but this is a important time. It gets a lot easier after this, I think. As long as AMC doesn't have any other corporate actions. Some of y'all are worried about a reverse split. That would be one corporate action. Some of y'all are worried about another ATM. That would be another one. I'm not predicting either of those, but I can't rule them out. So I'm going to say as long as those don't happen, things should get better starting with Q2 numbers. Yeah, we do. I do cover IMAX. It got a little bit pricey for me. It got a little bit overbought. So I'd like to not buy it where I think it's overpriced. We'll talk about IMAX after their earnings call this week. I do have a live stream scheduled to listen in to the IMAX earnings call. It's a solid company. If you own it and you got in cheap, congrats. I have owned it before. I exited the trade and took profits off. I was buying IMAX at $15. I sold at 24. It's at 36 now. So clearly I sold too soon. People always say, Tony says he sells everything at the top. No. I identify a price at which I'm willing to exit. And that price hit, and I exited the trade. And then it went sideways for almost a year. And my demand zone that I had drawn, it did not retrace down to it. So I missed the entry. Looking back, if we look at the 200 MA, that might have been something better to look at than just drawing a demand zone back to here. But, it is what it is. And now we need to move the yield supply zone way up here now. And the demand zone. But we will talk about this more after their earnings call, and I'm able to chew through all their numbers. and says, not in a million years, the way he spoke of a recovery plan, did I think the price would get to this level. I never thought it would get to this level either, to be honest. But we knew that there were problems a year ago, and we saw that they were once again, like in 2022, running out of cash and shares. That problem if box office isn't allowing them to raise, to be cash flow positive. A lot of these problems go away with better box office. So those of you who are looking for where is the light at the end of the tunnel must have better box office. And AMC talks about that in the beginning of the 10K. I would recommend, especially if you've never done it, go read the first 20 pages, especially the first 5 of the 10K. Talks about risk factors. Things that you guys are effing tired of me talking about. But why do I bring it up? Because they tell you what to be worried about. And then you can decide, well, I'm not worried about that. Or thanks for telling me. I need to factor that in. And they say if box office doesn't improve, there's going to be some problems. Big problems. They're not telling you that to scare you. They're telling you that in case box office doesn't improve, that you won't be able to sue them if they need to issue preferred again or do a reverse split. Like everything that you need to know about what could go wrong is right there for you to read. People want to say, oh, this company's a fraud. The CEO's creating crime. No. Everything that has happened in the last 5 years was provided to you in advance by the company, but people don't read. Not one thing that happened was a surprise. Interstellar Ape, how you doing? Isaiah says there are better stocks, ETFs, and cryptos to be invested in right now. It is a waiting game. If 70% of your portfolio is any stock, you may want to rethink your strategy. I agree. I mean, there are people, we'll end with this story. I love the GameStop people. Warren Buffett said, you shouldn't diversify because that means your initial first few ideas are not good enough. Like if your number one idea is the best, why would you need a number 2 idea? They bastardize what Warren Buffett meant. He had obviously a diversified portfolio. He was able to properly explain and identify what is a value stock. A value stock isn't identified by some jerk off on a website. What's that website? Wall Street. Simply Wall Street. SimplyWallStreet.com. You can go to GameStop on there, and there's a dozen different valuation price targets that people like you and me create. I created one. Mine hasn't been picked up in a news article yet, but the $220 guy, he's just a guy like you and me. His got the most upvotes on that website. Please go vote for mine. I'd love to see my price target in a news article. It's $420.69. Go vote for that one. I need about 16 more votes to be in the next article. Determining a value of a stock is not by making live streams saying, Simply Wall Street said the stock's worth 220 and it's only at 23, therefore it's undervalued. That is not a fucking analysis. That's a joke. A fucking clown show. Anybody telling you guys that shit. walk me through a discounted cash flow model. They can't do it. They don't understand how to do a value analysis, and they certainly don't do a value analysis like Roaring Kitty did back when he identified a deep fucking value where market cap was under book value. And now what is it? Are we under book value? No, we're well above book value. So as a value investor myself, I can't say this is a value stock, GameStop, but I can make a speculative bet on use of cash, transform earnings, to transform the valuation, to bring it up from where it is now, using any normal financial model that we would do to value a stock. They can put that cash to use and transform the valuation. That is my bet. Since that's only a bet, I don't have any defendable thesis for you on GameStop. It's a trust in Ryan Cohen. And some people will say that's a misguided trust. Well, it's not my only stock. It's far from a large position in my overall portfolio. So I know how to size a trade. Don't worry about me. JJ says during the pandemic, AMC was around 40 with no revenue, and today 117. I mean, JJ, we see a lot of stocks get run up far more than they're worth for no apparent reason. And AMC was one of those plays. I mean, the next video that I'm putting out is going to cover a penny stock. This was by a viewer request, a super chat request a couple nights ago. It was a 30-cent stock, then a $1 stock. Then what happened last year? It got promoted on social media and ran up to $10. The company's revenues were a couple $100,000 of revenue, and the losses were like $3 million. They have 60% of their debt in default because they didn't pay it on time. But the stock went from $1 to $10. How does that happen? You can't look back and say, well, that stock was at $10. I can't believe it's trading at 4 cents today. But it is, and it's probably only worth 4 cents because they don't make any money. They're losing money, and they're in default on all of their debt. That will be the next ticker I cover. It will be episode 5 of Pump and Dump Diaries. That is a playlist on my channel where we tell you, normally I tell you in advance what's going to happen. And we did try and tell people what was going to happen. So I'll pull a couple clips from a year ago when that thing was running. They're beautiful plays if you get in them early. I often am in these plays, but you have to know when to exit. And you got to be able to analyze the stock. There's no way a company that makes a couple $100,000 should have a couple $100,000 in revenue and losing millions with no real business, maybe 1,000 customers. There's no way they should have the market cap they had. It was promoted. Social media hype. If you can guess the ticker, you win a free drink. Not if you're in my Discord, you're not allowed to guess. So biggest surprise today, no MNPI. For many people, right? If you're in my Discord, you already know we were not predicting any MNPI. It was a nice to have, but it didn't happen. So now we got the numbers to chew through and think about. And I will be still here once a week or so, every couple weeks. Maybe we'll do a video or a live stream about AMC. And if we reach that magic tipping point where all the players are done moving their goddamn pieces around on the board, where I think I maybe have an edge, I will let you know. I'm not trying to be negative on this play. I'm just trying to not lose money. There'll be a time when I go long, and then they'll say, well, he went long, why? So he can talk negative about it. He went long because he's working for the short. Oh, God. I literally hear that in other tickers. He went long because he's working for the shorts. Bunch of fucking retards out there. No, I went long because I saw an entry that looked good, and I waited a long time for that entry. Baby UFO says, I don't see a path to avoid Chapter 11. What if I told you, baby, that here's a path, right? I can't say that this is going to be the path, but we like to analyze multiverse outcomes, right? What's the way things could go well? What's the way things could go to Chapter 11? We like to think about all of those and then assign probabilities to them. I would never say the only outcome is Chapter 11. There is an outcome where things get better, and that outcome is dependent on increasing box office. So if you don't see a path to avoid Chapter 11, then I would say, I would guess that you don't think box office is going to grow over 10 billion. And that may be, you might be right. I don't know. That's what we all have to grapple with, what we all have to think about. That's why even in AMC's 10K, in those first 5 pages or so, 520, I forget what page it is on. It says our success or failure is going to be dependent on box office growing. And in light of that, this is a speculative stock. That's not my words. That's the company's words. So that means people are betting. We're betting on various outcomes. How good are you at analyzing those outcomes? That's the question. The people that are only wearing the rainbow colored glasses are not very good at seeing any negative potential outcome. They're only focused on one outcome. And I'm sorry, there's a multiverse of outcomes, and yours has not come true for 5 years. So perhaps you should expand the people you're talking to and attempt to learn. Pulling out the Doctor Strange playbook. Yeah, I mean, I would say, you know, a 10.3, 10.4 box office this year, that's a very low probability on my multiverse. I'm not predicting anything like that. But if it happens, you know, the story starts changing rapidly. The outlook of everyone, analysts, credit rating agencies, management, news. You start getting people forecasting 10.3, 10.4 billion. If that were to happen this year, low probability it does, but if it were, then the story starts changing real quick. The only thing really to think about for the rest of this year is what is the box office going to be? Because if it's 9 billion or 9.2, we're still effed. Because it won't be enough to offset what we're going to lose in Q1. I know. I said rainbow colored glasses. I know it's rose colored, but I like to talk about the rainbow and unicorn YouTubers, the ones who are scared to death to be honest. Or, yeah, there's the ones who are overly negative, right? The Adam Aaron's a crook and the company's a fraud. No, everything that's going to happen is been in every 10Q and 10K. You don't read the risk factors. That's all it tells me. You don't read, and you're not trying to do any cash flow forecast, which is not easy. I don't blame you, but maybe tune into the channel from time to time. Ask some questions. Try to learn. This is a great educational opportunity. You don't even have to be in the trade. I learn something every week, and I don't own the stock. I learn about how lenders think. I learn about how they hedge their risk. I learn about how they short stocks to protect their bonds. I've created models and spreadsheets that are predictive in nature, and I keep on growing the usefulness of them. A year or two ago, I started doing cash flow forecasting. I wish I would have been doing all this stuff a year or two before that, but buying troubled companies was not something I really focused on for the last 30 years. I just buy profitable companies. So it's been a work in progress. But one thing I don't get locked into is I have one idea, and that's going to be my idea no matter what. And if I lose all my money, oh well. That was crime. No, it's not crime. You are not doing proper analysis. You failed to pivot when new data was presented to you. Really that simple. Once you can see the data behind the matrix, once you can forecast things, then you can potentially get an edge to know when is the right time. That's where I'm at. I'm just letting the days tick by, seeing if that day presents itself. If it does, I'll let you know. That doesn't guarantee I'll be right, but because, AMC don't talk to me. I don't know what they have planned, but I can use some experience and some analysis of box office and their financials to make some reasonable predictions about what's going to happen. Interstellar Ape says, when will AMC market cap become a deep value trade? It can't, Interstellar Ape. The book value of AMC is negative. It'll never be a value stock. Our very first, drawing the line on a piece of paper would be, is market cap under book value? Book value for AMC is negative. You can't be under that. So it will never be a value stock. The only question to ask, the right way to ask your question is, at what point do we have an edge on a speculative bet? Because everything is a gamble with this stock right now. It's a gamble based on future box office. Box office grows, AMC survives. Box office flatlines, AMC does not survive. Because you can't just keep on doing dilution like this every Q1 forever. And then even if you could, how are you going to pay off the debt? Every time we go to the lenders and ask them to move the debt out, they extract some form of punishing payment. Discounts on the bonds, exchangeable rates that are favorable to them. That can't sustain forever. We got to have bigger box office. Baby says, I wonder how many theaters got fixed up under the Go plan just to get shut down. Look, I see a lot of people talking about on social media, my theater is old and they're not taking care of it. If your theater is old and they're not taking care of it, it's on the shutdown list. The ones that are getting fixed up are the ones they plan on keeping because they do a ROI analysis. They don't just go spend money on something they're planning to shut down. They need to be able to get a return on their money, and they will forecast that and say, does that investment make sense in this location? If it does, they move forward. I would guarantee you there's presentations within the AMC Finance Group. Go analyze spending $2 million on this location. What's the payback period? Blah, 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 blah. If it doesn't meet some predetermined thresholds they have, it says, no, that one is not at the top of the priority to get any improvements. Bring me some that are better. Bring me some that meet our minimum thresholds. Any company finance team is going to have these return on investment thresholds that must be met. It's a hurdle. And for any of y'all that are still sticking around, you want to hear a quick update on the Go plan. CapEx did not increase from last year to this year. Capital expenditures didn't increase. It was 2025, $246 million. 2024, it was $245 million. There was zero incremental dollars spent on capital expenditures due to the Go plan. What does that tell me? It tells me that anybody who's complaining about them blowing cash on the Go plan is not looking at the financial statements. CapEx did not go up. Okay, but they improved a bunch of theaters. How did that happen? Some cash got spent. It was budgeted in CapEx. And my due diligence has led me to the conclusion, backed up with actual data, that a lot of these vendors, IMAX, Dolby, the moving seat people, the projector company, they are funding the Go plan through some sort of operating lease or a revenue share. So AMC is able to say, we're going to invest $1 to $2 billion. Yeah, that's the amount of what it would have cost them, the value of those investments over the next 4 or 5 years. But it's not coming out of cash. It's coming out of OPEX, for example. Let's see, did OPEX or up? OPEX as a percentage of revenue for 2025 was 36.8%. So OPEX, here's 2025 OPEX as a percentage of revenue, 36.8%. In 2024, it was 36.2, 35. This is what I think we need to keep an eye on over the next year and see if that OPEX as a percentage of revenue or just the spend goes up. Because the Go plan's being paid for somewhere. Maybe film exhibition costs. I don't know. They haven't really told us how they're paying for the Go plan, but maybe they will one day. We'll see. Sure would be nice. Be nice to get more info. All right, ladies and gents, 6:15. I'm going to go say hello to my wife before she heads out to work on the overnight shift at her hospital. And I need to eat something. And maybe we come back and do a live stream in a couple hours. But maybe we just take a break. We'll see. If you're watching on replay and you got any questions, as long as you can speak like an adult, not this childish nonsense. You work for the shorts. One guy told me, I blocked him this morning. He's like, you sure put a lot of time into making these daily videos. I'm like, what? First of all, no. Daily videos? Like, hello, crackhead. Huh? I write a tweet that takes me 5 minutes and then I cross-post it to YouTube. That, you think it takes me a long time to put this shit together, to put a tweet together? I live and breathe this stuff. I'm purposely not making AMC videos. Ding dong. Anyways. Love you guys. If you do have questions, drop them on the replay. And I will check them later.
A red candle down by the dip, gotta hold our ground. We've been waiting for so long, hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone, but the shorts we're going on. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down by the dip, gotta hold our ground. We've been waiting for so long, hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone, but the shorts we're going on. If you doubt it, sit and stare. If you love it, buy a share. A green candle up, a red candle down by the dip, gotta hold our ground. We've been waiting for so long, hedges rain will soon be gone. A green gotta hold our ground. Hedges gains are dead and gone, but the shorts we're going on. If you doubt it, sit and stare. If you love it, buy a share. Green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone. GameStop's rise is going strong. If you doubt it, sit and stare. If you love it, show you care. A green candle up, a red candle down by the dip, gotta hold our ground. We've been waiting for so long, hedges rain will soon be gone. A green candle up, a red candle down by the dip, gotta hold our ground. Hedges gains are dead and gone, but the shorts we're going on. A green candle up, a red candle down by the dip, gotta hold our ground.